US equities and US in general continues to be quite robust, and that's because over the last 6 to 7 decades, the country has developed a compelling formula for enduring long-term economic growth, but it's also created an environment that has been particularly rewarding for shareholders. And that's why the US continues to be a core allocation in client portfolios. And recently, investors have been questioning whether the US can continue its leadership or whether the factors of US exceptionalism still hold or are they broken. And we believe that those factors are still enduring, and it's because they are structural. The scale, the deep liquid capital markets, the less regulation, a concentrated pool of talent, academia, innovation, a really strong startup culture and a record number of IPOs happening in the US. But also notwithstanding the fact that the US has a large domestic population of 300 million people that is willing to try new products and services and that almost creates network effects because these businesses can scale locally before turning into global businesses. So these factors have led to superior productivity growth and earnings growth compared to other developed markets. And so investing in the US, unfortunately, has been investing, it's not confined to the Magnificent Seven, and that's very much been the story over the last 3 to 5 years, or AI. But there are a breadth of opportunities in the US, and that requires an active and diversified approach to access them. I think the US continues to be a core allocation in most client portfolios, as for the reasons that I've mentioned, but also because corporate earnings continue to look robust. So we've just finished Q4 earnings season. That marks the 10th consecutive quarter of robust earnings growth, which is unprecedented. And if you look at consensus expectations going forward for the next couple of years, those estimates are suggesting that A, earnings growth is going to continue, but B, earnings will broaden out beyond technology, which has really led some of those conversations on the US. So if you look at estimates for the next 12 to 18 months, double-digit earnings growth is expected to come from a wide range of sectors and industries, including healthcare, materials, utilities, parts of consumer discretionary, notwithstanding tech and communication services. So typically when you get broadening earnings growth, that does start to translate into broadening equity markets in the US. And we are seeing tentative signs of that in the US, with the S&P 500 equal weighted index outperforming the large cap index. However, investors are not positioned for this as they have huge exposures to the US via passive allocations. And so investors are now currently worried about geopolitical uncertainty, market concentration, expensive valuations. We've had fears of an AI bubble, and also we have the upcoming midterm elections in the US. So now it would be an opportune time to consider an active approach alongside your passive exposure to the US and really look for a strategy that can balance between capital growth and preservation, so it can help clients balance the risk-reward outcomes in the US going forwards. So Investment Company of America is Capital Group's flagship US equity strategy, launched in 1933 and with a 92-year track record. And it's also one of the oldest mutual funds in the world today. The reason why Investment Company of America is a credible proposition for clients going forward is it captures the breadth of the US economy, and that's underpinned by bottom-up fundamental research. And this is becoming increasingly important when valuations are expensive, there's pockets of froth in the market, but also when there's increased scrutiny on company fundamentals. The second is that through its active core and diversified portfolio, it's well positioned as equity markets broaden. The fund has structurally been underweight the Magnificent Seven and the tech sector, and it's outperformed despite being underweight those two areas of the market, highlighting that it's not dependent on the Mag 7 to be its key driver of its absolute and relative returns. So we're able to achieve diversified sources of alpha. And then the third is that the fund and the broader strategy has delivered a strong track record of consistency and resiliency. We've been able to deliver superior excess returns versus the index through a combination of upside capture and downside resilience. And we've achieved this pattern of returns by not taking on too much volatility compared to the market. So we really have outperformed with lower volatility and so balanced that risk-reward outcomes that we can deliver for our clients. And this translates into attractive peer group rankings within Morningstar's US large cap blend category, where the fund is top decile over 3 and 5 years. And on a Sharpe ratio basis, it's also top decile over 3 and 5 years. So this is the pattern of returns that we have delivered historically over our 9-decade track record, but it's also the pattern of returns we've delivered over the last 3 to 5 years, and it's also the pattern of returns we expect to deliver going forward.